Hello, everybody, and happy Tuesday. It is wonderful to be here with you. I hope you're having a beautiful week. Slightly different time because it's been a very, very busy morning as usual. Welcome to today's live level up conversation. Whether you're joining me live or you're catching me on replay, I'm just thrilled to have you here. Happy Tuesday. Let's dive right in.
Welcome to Level Up with Winnie Sun. Market update. Speed round. Award-winning financial pro. And now, get ready. I present to you Level Up with Winnie Sun.
Hello, and welcome to the show. I'm Winnie Sun, your host, award winning financial pro, a Forbes contributor, and a CNBC Council member. We are streaming live on over half a dozen different social media platforms. So jump in, take a moment, introduce yourself, say hello. I will say a big hello to all of you. It is great to be here with you. The market is still hasn't closed yet. So let's give you a really quick update. I'm looking Dow is currently down 184 points. The Nasdaq is down 5, so not too bad there. And the S&P 500 is currently down 14. We'll definitely check back again at the end of the show. But overall, the S&P 500, is remaining pretty much unchanged today, losing some momentum, of course, from yesterday. But we know we're watching very closely on tech gains and offsetting those by declines in the banking sector, which is really struggling today. In fact, if you've been reading the news or following this so far, it's not just the banking sector that's doing poorly. For those of you who maybe have done some back to school shopping or just looking at revamping your, I don't know, your wardrobe or even your exercise wardrobe. Well, unfortunately, Dick's Sporting Goods and Macy's both taking a pretty big hit. They're down pretty significantly, double digit numbers today. And we're definitely seeing some names such as Netflix and Alphabet, which is Google. They're on the positive though, so sort of offsetting that a little bit. But tech versus banking, that's the theme for today. But what I really want to do is I really want to talk about something huge. I don't know if you've been following, but I'm going to segue a little bit because I feel like everybody should be aware of this. And this is about the increase in mortgage rates. Now, if you are following me currently live at your home, which has a mortgage or which is paid off, if you have a mortgage and it's a fixed mortgage, you're probably breathing a sigh of relief, thinking, well, thank goodness I don't have to deal with that right now. I kind of feel that way because fortunately, my mortgage rate is reasonable and I did refinance during the early years of the pandemic, so it wasn't so bad. But if you currently aren't in your own home, you're looking to purchase a home, or you've been in the market just waiting for your moment. Unfortunately, I wish I had better news and I don't, because the housing market affordability just got worse. In fact, mortgage rates have now surged beyond the 7.5%, reaching a 21-year high. That's right. Experts are saying that this actually could near even closer and maybe even past the 8% mark. So right now we're actually over 7.5%. Real estate professionals are saying, well, this is going to cause a need for buyers and sellers to sort of rethink their game plan and expectations amongst the rising rates. Now, part of the reason that has occurred, of course, is because inflation has been high, and therefore the Federal Reserve has had to increase interest rates to help mitigate sky high inflation. A lot of that came because of the pandemic. Well, unfortunately, this is having a big impact on the housing market. Mortgage rates contribute to quite a sluggish housing economy currently. Now, you add that with what we're seeing in a lot of markets here in Southern California included, is constrained inventory. There's not as many houses being sold. And then you pair that up with sky high mortgage rates and, of course, high inflation, then that's kind of a recipe for financial problems right there. Financial Kind of a financial nightmare, if you will. So, Federal Reserve continues to have concerns about inflation. So that does lead to AKA higher interest rate expectations, which is just not helping the situation. To give you an idea of what that's looking at, the 30-year fixed mortgage um, has surged in the past 31 months. Now, this is causing, for if you're looking at a medium home price, like which is about $410,000 here in the United States, that increases your monthly mortgage by $1,200, $1,200. So that's pretty significant. With that, we also know with low inventory, of course, the U.S. debt was recently downgraded, and so the Fed's inflation concerns continue to contribute to increased longer-term borrowing rates. Now, rates have increased, of course, on new car purchases, on credit card spending, and debt, and student loans, and everything else in between. The yield on the 10-year U.S. Treasuries now exceeding 4.2% also marks a tipping point, which means it could potentially push mortgage rates towards 8%. Who'd even knows? Maybe even higher. I don't know. But yeah, so the average mortgage rate now causes tremendous pressure for our new home buyers. In fact, during its July 26th meeting, the Fed initiated a 25 basis points or a 0.25% increase of its Fed funds rate, which now marks the 11th increase of its current rate hiking cycle. Now, are we going to see another one soon? That's sort of the expectation that we will. And that's just going to cause these rates to get, unfortunately, worse. So, not good. So, give you an idea, inventory on homes sits at around over 1.1 million, certainly 15% lower than the previous year. And to give you an idea of rates, I think this is really key. Okay, the current average interest rate for a 30-year fixed mortgage is 7.62%. That's up another 11 basis points from last week. And this is sort of the most popular loan, but this is really significant. Now, it does allow for, of course, if you're going to get a 30-year mortgage rate, some of the advantages, of course, is a fixed rate, allows you more time to make those monthly payments, and therefore those payments tend to be much lower than versus a 15-year mortgage rate. But the 15-year mortgage rate, 15-year is currently at 6.83%, so less than 7%. Also an increase in 11 basis points since last week. And but because of the shorter term, it also means much larger payments. Now, this is great for someone who, really has their financial game on, and they know that they're going to be able to pay this larger amount, and they can afford, the shorter term to get that house payoff. But for most people do go towards a 30-year instead. Now, there's also what we call the 5/1 adjustable rate mortgage, or ARMs. Now, the 5/1 ARM usually currently carries an average rate of about 6.5%. This rose 8 basis points since last week. Now, how this one works is you typically, you get the lower interest rate for the first 5 years compared to the 30-year fix. But after that, it becomes an adjustable rate, which may not be good. Now, this type of mortgage is great if you know for a fact that you're not going to be staying in your property in the next 5 years, that you plan to sell or even refinance before that rate adjustment time happens. But if you're planning to stay longer, you probably want to go with the longer term mortgage. So, yeah, a lot of things to consider. But some of the things, what I'm going to do is this, because I do know there's been a lot of concerns about this topic. I'm actually going to prepare some notes and give you some tips. If you're looking to purchase a home, right, or purchase a new home, what should you do? What are some tips and advice that I would offer you? I have some really, really great tips I'm going to bring to you tomorrow. So you definitely want to join me again tomorrow. We're going to go into that, a little deep dive into that for those of you who are sort of watching and wondering how you're going to be able to purchase that new home. What are some tips and some tricks that maybe you didn't consider? outside of just like your 401k or borrowing from a Roth or borrowing from 401k or taking from Roth IRA or borrowing from your home and HELOC and whatnot. Because give you an idea, HELOC rates right now are over 8.8%. And even borrowing from your 401k doesn't make sense because that's based on your prime rate plus like 1 or 2%. So that's probably looking like 10%. Not a good idea. I've got some better tips for you. I definitely want to share with you on that tomorrow. Okay, so join me again tomorrow. Now, let's go ahead and segue to our next story. And this is from my friend Jessica Dickler from CNBC. And she's writing about what she's calling the rich recession. Now, what does that mean? That means you heard of like recession, but this is called the rich session. Hello, Joshua. I see you there. It's wonderful to see you joining us live on YouTube Live. I have a lot of friends saying, "Wow, big show." Okay, we're gonna talk about rich session for a moment. I just feel like this is going to be amplified given what I just talked about, increasing mortgage rates. Well, despite earlier predictions of an impending recession, the U.S. economy unfortunately has, I shouldn't say unfortunately, because it's actually good news. The U.S. economy has performed very well for the last two positive growth quarters in the first half of this year, 2023. And we continue to have a strong labor market. However, that's not great for inflation. And it certainly isn't great for mortgage rates. And yeah, so the gross domestic product, the GDP, rose more than expected in the second quarter of 2023. And the Federal Reserve interest rate increases have not led to enough of a contraction on inflation. So now, get this, recession is where sort of is disproportionate impacting on white collar workers. That's right. So less blue collar, more white collar now. And therefore, layoffs are hitting sectors like the banking sector, the tech sector, the service industry. Still faces a shortage of workers and unemployment remains low at 3.5%. But recession doesn't necessarily mean the entire economy is struggling, but more so that the broader economy is performing well, but white collar jobs appear to be declining. That's interesting, right? AI hasn't come full force yet. It's obviously something of a concern in the workforce and new jobs, but white collar jobs appear to be declining, and therefore they are experiencing the biggest amount of recession for new white collar jobs. So many Americans are continue experiencing higher prices and financial strain. We know that there's record high credit card debt. In fact, 61% of adults are now living paycheck to paycheck. But this economic period definition will only become clear sort of in hindsight. We'll see when we look back in history. But will this recession be declared? Is the recovery already in progress? A lot of stories still to unfold. Of course, I'll be bringing that to you as I learn more in the coming weeks and months as well. Okay. But yeah, there was a recent survey that basically said that global wealth is projected to rise significantly, but that'll continue to be inequality. And where the wealth will be generated, that's something we'll have to see. In the past, new wealth was primarily concentrated amongst the wealthy, the rich, both on an individual and country level. But this trend is sort of changing and changing pretty quickly. In fact, total wealth decreased in 2022 due to a decline in stock and bond markets. So we'll see. We'll see if the rich suffer more and the middle class can improve. And of course, lower income will improve as well. And try to see if things will even out a bit. We'll see. That's a story we're yet to follow. But there's been a lot more news about recession. And so thank you, Jessica, for putting that out on CNBC. Really, really appreciate your work there. All right. Those of you who follow the show know that we love to talk about Elon Musk. He's always in the financial news, so it makes perfect sense. But what we want to talk about now is for those of you who are still on Twitter, aka now X, and those of you who join me on these active discussions on Twitter, which is now X. We've also done something called a tweet chat. We do a really big tweet chat on Wednesdays. In fact, tomorrow, 11 a.m. Pacific, 2 p.m. Eastern, we have the biggest business tweet chat on social media. Well, for those of you who joined us, you have used all sorts of tools to be able to kind of keep up with the conversation. But here's a really big tool that many of you may use that's always been traditionally free that now is going to cost money thanks to X. This is called TweetDeck. Now, TweetDeck is getting a brand new name, and that's going to be called X Pro. This offers you the ability to customize your view and sort of monitor multiple views at a time, and a lot of trending topics. Now, historically, this was free, but now has transitioned to a subscriber-only feature. This is going to require a subscription to X Premium, and that's going to cost you about $84 per year. So I know that's unfortunately something people don't want to hear, but it is one of the new additions that has come from this $44 billion acquisition under Elon Musk and this new X. So I'd like to see what you think about that. Have you used TweetDeck? Is this a tool that you've used actively in the past? Are you disappointed that it's going away? I will say this, it was a free tool for many, many years, but for those of you who are active tweeters, now Xers, I guess, you probably noticed what I noticed. Like there wasn't a lot of new investment into this tool, being that it was a free tool. And so hopefully, now that, you have to pay for it, maybe it'll get better. I don't know. Lots of things to think about. All right, as we segue to more things tech, let's talk about this new thing coming out of Amazon. This is Amazon Pharmacy. And the next time you go to like CVS, Walgreens, you now have another option, and that might be Amazon Pharmacy. In fact, if you're diabetic, you might want to really pay attention to Amazon Pharmacy, because Amazon Pharmacy's new initiative offers insulin to diabetic patients for a low cost of $35. This is, of course, their participation in increasing transparency in drug costs. The company hopes to utilize sort of these automatic coupons that will provide diabetic patients with discounted insulin prices, which is such a big thing. My dad was diabetic, and I can tell you that was such a big part of his monthly budget. And now, this is addressing inefficiencies and a lack of access to reasonable cost insulin. If you've actually jumped and seen this on social media, many people talk about how expensive insulin is in comparison to how little cost it takes to produce this very necessary medication for so many Americans and people across the globe, especially in America. Insulin's been very, very expensive. So Amazon is going to align with other manufacturers like Novo Nordisk, Eli Lilly, and many other companies who are also offering similar discounts on insulin products. Now, they're going to obviously have a multi-step process. You're going to have to do some activations and whatnot. But if that's something that you use and rely on, that might be something that you want to consider. The company's pharmacy offerings have grown to encompass Prime membership pricing for select drugs, generics, and other types of drugs. So we'll see. We'll see if this helps you. But legislation like the Inflation Reduction Act and a lot of lobbying by the American Diabetes Association have now helped to cap insulin prices for Medicare beneficiaries and state-regulated health plans. So we love that. We like getting those prices reasonable to people that really, really need it. The cost of diabetes remains significant concern for Americans all across the globe. And people across the globe. It's a big, big topic. So hopefully this is helpful. And if you are using this medication or someone that you care about is as well, it's good to sort of examine your different options, check with your local pharmacy, check some of these online pharmacies to see which program works best for you, which one's reliable, and of course, which one fits your budget. Okay, so with that, that's going to be my cap for today. I'm going to go ahead and check and let you know how the market is doing currently. Currently, the Dow's still down 173 points, The Nasdaq has turned positive now, up over 1.37, and the S&P 500 is currently still down 12 points as well. So we'll continue to pay close attention to that. I've got a lot of stuff going on this week. I'll continue to update you on some of my media appearances. I have a lot of media appearances this week as well. I'll share that with you on a future show. And so hopefully you can see me on air and maybe, let me know what you think. If there's anything that I missed that you think I should have added, always looking forward to improve, of course. And if you're able to help share, I would truly, truly be grateful. Thank you so much. Heartfelt gratitude to all of you for joining me, part of this Level Up Live episode. And if you found this video valuable, make sure to hit that like button and hit subscribe so you'll always be on the know for our next new update. And you can find full episodes of Level Up with Winnie Sun on NASDAQ, Amazon Fire, Samsung, LG, Roku, and many other streaming platforms. And if you share this episode online, tag me at Winnie Sun. And thank you on a future episode. With that, have an amazing day. I'll be back again tomorrow, and I hope to see you there. Take care now. Bye-bye.